Hi, and welcome to Debt Tale. I'm Rebecca, and we'll be going over 8 debt payoff methods. Please understand that this is a general overview of a few debt payoff methods. The content is for informational purposes only. You should not construe any of this as financial advice for your particular situation. In order to evaluate your own situation, what you want to do is have a spreadsheet or a piece of paper that lists the following information for all of your debts. You need the debt name and type, principal balance, minimum monthly payment, annual interest rate, and for one of these methods, you need to calculate the monthly interest payment. So to get your monthly interest payment, you have to convert the APR into a decimal, which means you divide that by 100, and then divide it again by 12 because there's 12 months in a year. Now you multiply this number by the minimum monthly payment and bam, now you know how much of that payment is going towards interest. Please remember that in all of these methods, you continue to pay the minimum monthly payment for all of your debts. If you focus on one and don't pay the others, you're really going to tank your credit score. First one is Debt Snowball, a really popular method. What you want to do is focus on the balance and arrange your debts in order from smallest to largest balance. Assuming that you have some small balances, this allows for some wins because what you want to do is pay the smallest balance first. As you do that, you roll over the monthly minimum payments to the next loan in the sequence, therefore building momentum. Debt Avalanche. Now, Debt Avalanche focuses on the APR rate, and you organize your debts from highest to lowest APR. One that you're tackling is the one with the highest APR first. Generally, this is a credit card or a personal loan. Mathematically, over time, you're paying less money in interest because you're tackling the highest one, and therefore, again, saving a little bit more money on your total debt payoff journey. And just like the previous one, you continue to roll over your payments to the next loan you tackle. Debt Fireball. Now, Debt Fireball is a newer one. It's a hybrid mix. What you want to do is organize your debt by APR first. Any debt over 7% APR is considered bad debt, and any debt under 7% is considered good debt. What you want to do is for the entirety of this plan, you want to pay the minimum monthly payments on the good debt. Then you're going to arrange the bad debt by balance and then focus on paying off the smallest balance first. You're going to roll over that monthly payment to the next bad debt until all bad debt is paid off. Once it's paid off, you get a chance to pick what you want to do with that money, which is you could invest that amount, you could save that amount for a goal, you could use that money for fun, or you can continue to pay off your debts to be completely debt-free if that's your goal. Next is Cash Flow Index. Now, Cash Flow Index is a payoff method which uses a formula to identify the debts that have the most impact on your cash flow. So in order to create your cash flow index or get that number, you take your balance and you divide that by the minimum payment. If the number is 50 or under, it's considered an inefficient loan. If that number is over 100, it is called an efficient loan. What you want to do is you're going to pay off the smallest CFI loan first. So the smallest number you get, under 50, that's the one you want to tackle first, and you continue to work your way up through the inefficient loans. For loans that score between 51 and 100, you consider restructuring them into more efficient loans, which means either consolidating them or paying them off after you tackle the inefficient ones. Again, this is all dependent on your goals. Do you want to be completely debt-free, or do you want to just get rid of the ones that are affecting your cash flow most? Highest monthly payment. This one's a little bit self-explanatory, which is trying to free up the most money to continue paying off. So you're going to arrange your debts by monthly payment and tackle the highest one first. Once that one's paid off, you roll over that amount to the next highest. Again, the idea behind this is to free up more money to tackle debt quicker. But again, this can also take a while to see progress because generally loans with the highest monthly payment tend to have the largest balances. Highest monthly interest. Ooh, this is where you had to do that math from the previous slides, which is calculating the amount of interest that is coming out of your minimum monthly payments. Once you have that, you can focus on paying the highest monthly interest amount, so you tackle that loan's principal sooner. Another way, or another quick way to do this, is to create amortization tables of your loans to help you figure out how you are accelerating your debt. Note that you have to keep reviewing your amounts because you could be focusing on the wrong loan after a short time. So basically, you just have to recalculate every couple of months what your monthly interest rate is because it may change which loan has a higher monthly interest rate as you tackle balances. Good grief, payoff. Pay the debt that's bugging you the most. So each debt has a story of why you had to take it on, and sometimes one bothers you more than another. So what you want to do is arrange your debts by what is bothering you the most and pay that one off and then focus on the next one. Sometimes the relief of no longer paying for it sometimes is more rewarding than tackling smaller, less meaningful debts for you. Highest credit utilization. This one's really for credit cards and line of credits. This, you need to figure out your credit utilization, which is your balance divided by your credit limit. Then you're going to arrange that from highest to lowest and tackle the highest. Paying down debt accounts with high credit utilizations is a great way to improve your credit score. Ideal credit utilization, if you care about your credit score, is under 30%, but the higher impact is actually under 10%. But wait, there's more. Yeah, seriously. These are just a handful of debt payoff methods. There are so many other ones out there, and they all just have little riffs from one another. Still, each one can be modified or combined with other elements because debt payoff is really flexible. It really just comes down to what makes you feel best. Well, thanks for watching. I hope you found this video helpful. If you have any questions, please drop a comment below and I will either like it or answer it. The slides are available as a free PDF, so you'll find a link to the slides down in the video description, and don't worry, I'm not asking for your emails. Also, this slide won't be in there. I'll be making a video on each of these 8 methods with the same sample debts just to show you how the methods may change the payoff orders. And I will update the description with the links as I publish them. Alright, have a great one.